Hello and welcome to this webinar. My name is Stanislav Bernikov and I'm a full-time professional trader with more than 10 years of experience. I will be your host in this webinar where I'm going to share with you some interesting information concerning trading. If you have any questions, feel free to leave them below this video. Enjoy! Let's get started. This webinar is dedicated to the topic of profit taking. In a previous webinar on stop placement, I've shared my view on managing losing trades. But eventually we earn money when we exit a trade with a profit. So in this webinar I will focus on profit taking, which is now a less important topic than stop placement. Most of ideas discussed in this webinar were somehow used for trading either for me or students of my educational groups. Now we are ready to start. And before we start, let's take a quick look at the disclaimer. Please beware of financial risk associated with trading. Information in this webinar is provided for educational purposes only and by no means can serve as a trading or investment advice. You will have full responsibility for your trading decisions, so we strongly encourage you to test any ideas or concepts on a simulator or using a historical backtest before putting real money at risk. And first of all, I want to say that taking your profit is not a science. You just can't be told by someone that you should do certain steps to fix your profit correctly. And after all, there is no right or wrong in the market. Well, first of all, of course, you have to have a profit. We assume that you are having a profitable position. Only after that you can decide whether you want to take this profit from the market or whether you want to let this profit run. And as I have said, there is no right or wrong in the market, but nevertheless there are several key principles that might help you to set more adequate targets and exit a trade before price reverses and you give back to the market most of your paper profits. By paper profit we mean profit that is not fixed yet. So there are several principles. First of all, you can take your profits using average daily range or daily volatility, or you can employ logics of a measured move, or you can use sometimes harmonic patterns or harmonic numbers. Then you can observe price action, and finally you can use a trailing stop when you decide not to take your profit and when you decide to let your profit run. And let's start with the first idea, which is based on average daily range. The idea beyond this method is that you don't try to understand the market. You just measure average statistical deviation of the price and assume that market will experience difficulties in sustaining the move once it overcomes the average deviation. First, you have to measure average size of the daily bar or a candlestick. I want to stress one more time that we take daily bars. It is not a method for 30-minute or 5-minute bars. Principle can be pretty much the same for different time frames, but in the context of this webinar we are talking about daily bars. Then, if you enter a long position, you see how many pips were already completed in the context of the suggested move. For example, if average size of the daily bar is 100 pips, and your location for entry is 50 pips higher than the suggested low of the bar, you have more 50 pips before the market will possibly reach the resistance or reach the suggested high of the day. And you can set your take profit order at the suggested price, taking your profits out of the market. Of course, price action can be updated for the very next day, but if you hold your position overnight, you automatically accept risks of higher time frames, so you can't afford tight stops or tight trailing stops in this case. And if you trade within a day, you are about to make a decision where to exit your position within this day, so it can be a reliable price calculated from the historical data. Of course, when we are talking about average daily range, we assume that we don't know the exact volatility of the bar, so it is an assumption. Of course, price action can be updated much higher than our suggested price. In this case, we can have a trending day. Trending days are very different from average days because they can generate 150 or 200 pips in just one day, when price action starts to go from the beginning of the day and it ends only as the day closes. So trending days fall out from average statistical numbers. Now let's talk about methodology. To measure average size of the bar, you can use average true range indicator, or ATR. You are familiar with this indicator from the previous webinar. And for daily chart, you can use, for example, 50 days as a parameter. It is an average, it is not a holy grail that can allow you to capture highs and lows of each day. And remember that we are talking about profit taking, not about entering a trade. Market action can stop at some point, but it doesn't automatically mean that you have opportunity to go against this move. Now, what do these numbers mean? You see average to range indicator here with parameter of 50, and you see that average size of the day or a daily bar can be estimated with this indicator, and it is equal to about 80 pips. So it means that if you measure the distance between high and low of each day, you will have the average number of 80 pips. Well, of course you have trending bars, or trending candlesticks like it is shown here. I believe it was December 4th or December 3rd, I don't remember exactly. It was about 400 pips. This bar or this action falls out from the statistical deviation. And that's why we can't rely just on the ATR or just on the statistical studies. But the majority of other bars or other candlesticks, they fall pretty accurately inside this calculation. You see that all bars or all candlesticks, they are not too elongated, they are average, they are normal. On the next slide you see the example of typical false breakout occurred at November 23rd, 2015. I was showing you this example on one of previous webinars. It was long trade from American dollar versus Canadian dollar captured here. I was holding this position for 3 days and finally closed this position on a pullback. So that time I was not using any take profit orders, I was using trailing stop for closing my position, and I will explain you later why. In some cases it is affordable to have trailing stop. In a nutshell, I have decided to use trailing stop instead of take profit order here because here I had important extreme or important level. And in case price could have accepted this level, I could have seen significant breakout to the upside. But that time market had simply tested this level. It had generated the normal day or the average day and reversed. So where do we take this number from? On the next slide you see that the value of ATR for that period was equal to 75 pips. So we could have set our first target on expected high of this bar in case we had a long position and we are not heading for the large movement. If our duration of the trade is no more than 3 days, for example, then we can use average statistical number to calculate point for profit taking. And of course, if we are going to trade within a day, we have to compare our trade location with location of suggested extreme of the day. So if we wanted to trade on Monday, if we had no position before, if we wanted to just enter a long trade, we should look how many pips do we have before the market will reach the possible or suggested high of the day. In this particular case it might be a very small number like 25 or 30 pips. So imagine that you are risking, let's say, 15 pips to earn 25 pips. Well, it is not very good trade because the profit-loss ratio for this trade is not too good. And of course, sometimes you can capture a trending day, so if you feel that market conditions are good for generating a trending day, sometimes you can enter your position even if your trade location is not so good. Let's look at distribution of volatility for euro versus American dollar presented on this slide. This graph shows relationship between frequency and magnitude. Frequency is the number of outcomes in a whole distribution of data. Magnitude shows how large was the deviation. And at the first sight you might decide that it gravitates to a normal distribution or a bell curve. But the real distribution of results has so-called fat tails. It means that probability of extreme events is a bit higher than for the normal distribution. For the market it means that trending days tend to combine into clusters. They tend to combine into series. And sometimes volatility can be very high, it can be unexpectedly high. On the next slide you see the example of such shift in volatility. There are times when trending days with high volatility assemble into series, into clusters. It can be 2 or 3 days in a row or more, but it allows trending systems to generate returns far greater than average from time to time. And if we get back to the previous slide, you might think at the first sight that the most stable trading style is scalping. And to generate consistent profits you have to place very small take profit orders with no stops. But in reality such approach will inevitably lead to a loss of entire trading account. Because if you do so on the market presented on this slide, it becomes clear how it works in real time. Say you are in a long position here and you are averaging your loss, or you're placing a very small take profit order, and then having 3 days in a row going against your position means that your entire trading account will be lost. So in some cases it might be reasonable to have volatility on your side, not having probability on your side. Because in this case, when you try to work at the low of this bar, of course you might sell in the area where you will have expected low of the bar. That's why on the example shown before I have told you that I was using trailing stop instead of just fixing the profit on the expected high of the day. So if we have a normal day, this idea fails. I give back some of the paper profit accumulated for the period of 3 days. But if market is going to the upside, is breaking out to the upside, I get very good profit loss ratio and my trading account starts growing very rapidly. Now let's talk about technical analysis and switch to technical analysis from statistical studies. Technical analysis is absolutely not a science, and every trader has a unique perspective on what is happening in the marketplace. And another method of placing take profit orders is employing the old principle that nevertheless remains still relevant for today's trading as well. It is principle of a measured move. AB equal to CD means that most of the time market tends to generate symmetry between legs of any trending move. If you remember any pattern, any chart pattern like triangle or flag or pennant, which are patterns of continuation, you might remember that the principle is pretty much the same for such patterns. You see the pattern, you measure the move that preceded this pattern, and then you just project this move to the next leg, and you set your take profit order using these dynamics. In reality, it is not so easy to find classical patterns mentioned above, but we still can use this principle for rotational centers that we have discussed in previous webinars so far. If we identify rotational center, it can serve as a starting point for the second leg. It's very important to know where the second leg is going to start. Rotational center in this case will serve as a starting point. On this slide you see daily chart of American dollar versus Canadian dollar, and rotational center here possibly falls into the spot of low volatility. And it shows us the starting point for the second leg of the move. First leg, or AB, is considered to be built this way, and CD leg is considered to be built like it is shown here. So you see that AB is equal to CD, or almost equal to CD leg here. Okay, I want to show you one more example from 30-minute chart of Australian dollar versus Japanese yen. And rotational center here is possibly located at level 88.65, which I show you by the red line. This is a level of reduced volatility. If you see at the previous dynamics of this currency pair, you see that this level shows reduced volatility. Market sort of consolidates around this level. Then again you see pullbacks, reduced volatility again. And finally the initiative which starts from this level is going to be the second leg, the leg CD. So how are we going to measure our target in this case? We can build a symmetrical or measured move here. So here is a rotational center. Let's mark it with letters RT. Then once market starts to go away from this level, we build a measured move and estimate our projected target. Projected target will be located here. You see this is a pretty accurate point. After reaching this point, market reverses, but not every time market is going to reverse. It is just this example, but this example shows pretty accurately how the measured move actually works in a real time. So you see this is pretty good trade. And another interesting example is from New Zealand dollar versus American dollar, from the recent price action, from the recent market. You see that rotational center is located at 0.6711 because volatility is going to become very reduced along this level. You see a couple of pullbacks. Market is leaning to this level, but you also can see that market is unable to reach the projected target at December 15th and December 16th. Projected target can be measured by the rotational center, so we can't reach the projected target, but also notice what happens later. After the week or about 5 to 6 days of continuation to the sideways, market eventually is reaching the upper side of this range. It doesn't happen very quickly, but eventually it happens. So if we switch, for example, to 1 hour chart, we also can see that the logics of the measured move eventually is working here as well. Sometimes we have to decide how distant the A point is going to be located from the rotational center. For example, here it is a 4-hour chart. I have put the higher time frame here to show you a bigger picture of this example. This is Euro versus British pound, and you see the rotational center, which shows us reduced volatility, is located at 0.7287, and we have several points here that might show us possible A points. And also, this can be the AB leg. So if our action starts, if our point C is located above the rotational center, so where is the D point located? In fact, I don't see any conflict here because price can reach several targets. It might be intraday target or a small target, and it might be a larger target. For example, here on this example, we have smaller target achieved first. And then probably the larger target can be achieved later. But also before it happens, market can also go sideways for a while. It might elongate in the trading range. It might show us elongation in the trading range. And only after that, for example, it can reach the distant target. So the larger time frame you are operating on, the larger target you want to capture, the more prepared you have to be to see sideways action before your scenario is executed. And another situation on the British pound versus American dollar can show us that if we notice 1.4514 as a rotational center, you see a reduced volatility here. Okay, we have pullbacks here also. So this level serves as a rotational center. We can have also several targets, and the more probability we have reaching the closer target. So small trading range or small target, small CD lag is going to achieved with greater probability than larger one. Larger one is not achieved yet. So you see what happens. We have several targets and we can operate with smaller targets and larger targets. There is no rule, or it's not a science. Nobody will tell you where to take your profits, but if you're okay with having smaller profits, if you are okay with having I don't know, 100 pips or 80 pips of the move for the profit, then possibly you should take your profit here. For example, if you have entered at a possible C point, you have placed your stop, and you are a swing trader operating on time frames from 1 to 3 days, so possibly this is your exiting point. You have to exit here. But if you switch to higher time frame, for example daily bars or daily chart, you can have broader perspective, and using this rotational center 1.4914, you can build broader perspective, and in this case market will unlikely go to the larger target, to 1.4623 immediately. It will rather try to first consolidate in some range, maybe to make a correctional move, and only after that it will be ready to reach this target. And also, this is not a guarantee that market will stop at this level. It might go further. But you, in this case, are having pretty clear perspective of profit taking. You know exactly when you are going to exit a trade. That is your possible C point, and that is your D point. Another way to choose a price level for profit taking is to use harmonic structure. It can be either Fibonacci levels or Elliott waves. In my trading I don't ever use Fibonacci retracements, but from time to time I build Fibonacci extensions. There are two most frequently appeared numbers. It's 161.8% and 123.6%. For a trending market we can use the first type of extension, built by the height of correctional move. It is very important because the popular method is to use impulse, the height of the impulse. Instead, I recommend to use the height of correctional move because it works better in many cases. As for range-bound market, it is better to use closer target, such as 123.6%. The example of this slide is showing Euro versus Japanese yen. It is the daily chart, and you see how extension of 161.8% works. We use the correctional move, the first significant correctional move, as a base. Then we build an extension, and we get the approximate level for profit taking. It is equal to 129.85. In this case, it is clear how it works. It works pretty accurately. Not every time market is going to reverse here. Sometimes it just stops, it goes sideways for a while. But that's what we need. We don't need to be in position which is going sideways. If we are working with a trend, we want to go with an active type of trend. We don't want to sit in our position just observing how price is going back and forth. We want to get out quickly and to switch to new trades and new trading ideas. The next example is showing application of range bound extension, which is 123.6%. It is daily chart of Canadian dollar or American dollar versus Canadian dollar, and you see that again we are using small correction. It is trading range which is being extended to the upside, and we see that this number works also pretty accurately. Not every time it works, of course. Sometimes market goes beyond this level, but in fact, if we want to capture small deviation from the trading range, small false breakout from the trading range, it is pretty good number that is proven statistically, and you can observe this number on many charts. Okay. Now let's switch from visual structure to the price action. Visual structure is not the only way to identify exiting point for your trade. Sometimes you can act upon the situation observing dynamics of the price action. You can observe tempo. An accelerating tempo can sometimes tell you a better story than any visual framework. And one of the most frequently appeared patterns is parabolic acceleration. Imagine that you see price going in some direction. You see new highs, new lows. Then it starts suddenly to accelerate. It can indicate culminational move, which is about to stop price action soon, if not reverse it. Of course, if you put this pattern in the context of statistical deviation that we're talking about so far, we can achieve more confidence in our actions. Here, let's say we have 80 pips or so, 80 pips of the height. So if we are in position, for example, we enter the position somewhere here, I don't know, using whatever pattern, market is going down, and immediately it starts to accelerate, reaching the suggested low of the day according to daily ATR. It can be 80, 75, it can be whatever. But you see that market is entering the area which probably can act as a support or as a pivot point, reversal point. Considering that market is possibly going within the culminational phase, you may want to exit this trade if you are a day trader, of course. For a swing trader or for position trader it works pretty differently. But for the day trader it is the good way to exit your position. Okay, and a few words about letting profit run. Good traders often have the habit of increasing perspective for profit. Below is a chart of Volatility Index for S&P 500 stock index. And you see that sometimes volatility is going mad. From time to time we have very big swings, not only on stock indices but also on currencies as well. and employing any trend following strategy, you want to decide to have your profit running. And this is the way you can use it. For example, if you are in position, you can also apply the ATR indicator to set your trailing stop order. In this particular example, we have ATR equal to 90 pips. So to hold our position, we have to multiply this parameter by 2 and get approximately 200 pips. It will be our trailing stop that is going to be robust in such kind of market conditions. So you just move your trailing stop order using the parameter of 200 pips. I will not focus too much in this webinar on trend following strategies and letting profit run, because it's the wholly different topic. It's the separate topic that is going to be covered in a separate webinar. Thank you for watching this video. Please ask your questions below this video if you feel that you want to ask any question. Please be specific in your questions to receive a good answer. See you in the next video.